Welcome to the Deck Dive. Today we're digging into the latest numbers from Hindustan Unilever Ltd, HUL. We're looking at their unaudited results for the quarter and half year ending September 30th, 2025.
Yeah, and it's an interesting one. There's a bit of a puzzle here in their official filings. You've got these big positive structural changes happening, like the big GST reforms meant to make things cheaper.
Right, should be good news.
Exactly. But then you look at the key number, underlying volume growth, UVG, and it's flat, 0% for the quarter.
Zero. Okay, so flat volumes when things should theoretically be getting a boost. That sounds like there's some friction somewhere, like something temporary gumming up the works, masking what's really going on underneath.
That's precisely it. And our mission today is to unpack that transitory impact, figure out how disruptive this GST change really was in the short term, and also look ahead. They've got a new CEO with 4 strategic pillars. Are those going to be enough to really ride this wave once the dust settles?
And we're basing this all on their official releases, the outcome from the board meeting on October 23rd, the financials themselves, and the transcript from their investor call.
Okay, so let's dive into the headline numbers for Q2 fiscal 26. Consolidated underlying sales growth, USG, came in at just 2%.
Just 2%.
And as we said, underlying volume growth, UVG, totally flat, 0. So straight away, you know that 2% sales growth wasn't from selling more stuff. It had to come from price changes somewhere in the mix.
Okay, but here's where it gets a bit, well, tricky. The profit after tax, PAT, actually went up 4%. Ours, 2,694 crores, looks decent on the surface.
Right. Then you peel back a layer, look at PT before exceptional items.
Yeah.
And that actually fell by 4%.
Fell 4%. So wait, how do you get a +4 headline from a -4 reality? That's an 8-point swing. We definitely need to unpack that exceptional item.
Absolutely. This is classic stuff you find in financials. That apparent 4% PAT growth, it was entirely down to a big one-off positive hit, 273 crores.
Okay, where did that come from?
It was from sorting out some old tax issues. Basically, a resolution between the UK and Indian tax authorities regarding previous years. It's got nothing to do with how the business actually performed in the quarter.
So, let me get this straight. The core business, the actual selling of soap and shampoo and food, was actually 4% less profitable than last year. But because of this tax settlement, the final number looked like growth.
You've got it. So listeners, you need to see that the underlying operating result was softer. Profits were under pressure, partly from those flat sales, and partly because HUL actually invested more money during the quarter, likely aiming for future growth.
Right. It really highlights why you can't just look at that main PAT number and call it a day.
Never. You always have to look under the hood.
Okay, so operationally it was a soft quarter, but the board still seemed confident enough on October 23rd to make some financial moves.
They did. They approved the results, naturally, but they also declared an interim dividend. Pretty solid one, too. Ours, 19 per share.
19 rupees. And for anyone holding HUL shares listening in,
Key dates for you. Record date is November 7th, 2025. And the payment should hit accounts around November 20th, 2025. It does signal they expect things to look better down the road, despite this short-term noise.
let's talk about that noise. You mentioned the GST changes were supposed to be a positive tailwind. So why flat volumes? What were the specific headwinds they called out?
They pointed to 2 main things. The biggest one, the dominant factor, was what they call the transitory impact of those GST changes. The shift was just so big and happened so fast, it temporarily kind of froze the pipes.
Froze the pipes, okay. And the second factor?
Just bad weather, basically. They mentioned prolonged and intense monsoon conditions in several parts of the country. That always tends to dampen demand, especially for things like ice cream, maybe some other less essential items.
Okay, let's focus on that GST disruption because that seems key. How big a deal was this rate change for HUL?
Oh, it was huge, massive. This wasn't just a minor adjustment. The change directly benefited, get this, 40% of their entire product range. Moved all those items into the lower 5% GST bracket.
40%. Wow. So nearly half their business is now in that lowest 5% slab.
Exactly. That's a fundamental shift for affordability. And HUL, to their credit, reacted super quickly. They used the word agility. They went and made pricing and pack size changes across more than 1,200 different SKUs stock-keeping units.
1,200 products adjusted almost overnight. The idea being to pass that tax savings straight to the consumer.
Yes, pass the entire benefit on. That secures the long-term win, right?
Yeah.
Better affordability, more money in people's pockets eventually, maybe better consumer sentiment down the line. But doing it so fast created this massive short-term bottleneck.
Right, that bottleneck. That's the key insight here. What exactly happened? Why did the market stall like that?
Well, think about it from the perspective of the shops and distributors. First, they had all this old stock sitting there at the old higher price. They had to sell that off first.
Makes sense.
Second, distributors held back on placing new orders. Why buy today what you know will be cheaper tomorrow?
Yeah, logical.
And third, even us, the consumers. If you hear prices are about to drop on your detergent or shampoo, you might wait a week or two before restocking your pantry, wouldn't you?
Definitely. Wait for the lower price to actually show up on the shelf.
Exactly. So all that together created what they called pricing volatility. It just put the brakes on everything temporarily. Inventory jams, order delays, purchase postponements, a full supply chain freeze, pretty much.
Across 1,200 product lines. Okay, that paints a picture. And management thinks this is purely temporary. They're saying normal trading should resume, what, early November?
That's their bet. Early November, once the new prices are fully in the system and stable. It sounds ambitious, maybe, because these things can sometimes drag on.
Yeah, a change that big feels like it could cause ripples for a couple of quarters, not just a few weeks.
It could, but I think their confidence comes from believing the underlying demand is still there. This isn't a problem of people not wanting their products. It's a problem of trade mechanics, of inventory flow. They're banking on pent-up demand, snapping back quickly once things normalize, especially with the added boost from lower prices.
Okay, so the structural story, more affordable products, potential for people to trade up later, that's still intact, just hidden by this temporary fog.
That's the argument, yes.
All right, so that flat volume was the overall picture. But HUL has different divisions. Did any part of the business manage to perform better? Were there any bright spots in the segments?
Yes, definitely. If you look at home care, that's their biggest division, things like laundry and surface cleaners. They actually had pretty decent volume growth, mid-single-digit UVG.
Mid-single digits, that's good. So why was their overall sales growth flat then?
Because of pricing. They had already taken prices down quite a bit in previous quarters in home care. That was driven by falling commodity costs, especially crude oil, impacting things like packaging and ingredients.
Okay. So good volume in home care, but the revenue didn't grow because prices were already lower. They chose affordability there.
Exactly. And they're pushing market development too. Their liquids portfolios and liquid detergents, dishwash liquids, saw double-digit volume growth. That shows people trading up, and they launched a new premium product, Comfort Perfume Deluxe, a fancy fabric conditioner, very much playing into that premiumization trend.
Interesting. Okay. What about beauty and well-being, B&W? They managed 5% sales growth. Where did that come from?
Mostly from skincare and their health and well-being business. That health and well-being part is really flying. It's built around acquisitions like Oziva, and Oziva itself saw triple-digit growth.
Triple digits. Wow, that's clearly a strategic focus area then. High growth, probably high margin too.
Definitely. And they're pushing into new spaces there, like this beauty from within idea. They launched Oziva Phytoceramides plus Collagen Builder. It's basically a supplement you take for your skin. Very niche, low penetration category they're trying to build.
Building the market from scratch almost. What else in B&W?
Some specific skincare launches too, like Vaseline Cloud Soft, designed for Indian facial skin apparently, and a new Pond's Hydra Miracle Moisturizer. Hair care, though, saw its turnover drop. About 90% of the hair care portfolio was hit by that GST rate change, so it saw the same kind of disruption we discussed.
Got it. Okay, moving to personal care. PC. Flat turnover growth there, also blamed on GST, but you mentioned premiumization earlier.
Yet even with flat overall growth, they saw double-digit growth in their premium soaps. That's a key indicator, isn't it?
Yeah.
People might buy the same amount of soap, but they're choosing the slightly fancier, more expensive bar.
That trend seems pretty resilient.
It does. And they refresh things, too. Relaunched the classic Pears soap and expanded the Lux International range with added skincare ingredients like glutathione and vitamin E, again, pushing that premium feel.
And finally, foods. Came in at 3% sales growth, low single-digit volume growth.
Yeah, beverages. So tea and coffee did well, double-digit growth there. But ice cream took a hit. That got the double whammy.
Yeah.
The long monsoon and the GST transition impact, turnover decline there.
Makes sense for ice cream. Any innovation in foods?
Yes,
Yeah.
in the nutrition space. They launched Horlicks Piero Fitness. It's pitched as a science-backed meal replacement product, tapping into health and wellness trends.
Okay, so that covers the sort of tactical quarter-by-quarter performance, but you mentioned a new CEO and a new strategy. This feels like a bigger shift is underway.
Absolutely. This is the long-term blueprint they laid out. 4 main priorities to get back to what they call volume profitable growth.
All right, what are they?
First, really sharpening how they segment consumers. They're talking about 3 specific groups: power spenders, premiumizers, and democratizers. Basically, understanding the different needs and budgets much better in today's economy.
Okay, more targeted marketing. Makes sense. Second,
Elevating brand desirability. That means two things. Boldly modernizing their big core brands, like renovations, new campaigns, and really scaling up that premium end of the portfolio we've been talking about.
keeping the core fresh while pushing the high end. Got it. Third,
Future-proofing their capabilities. This is all about digital. Accelerating their presence in that's digital commerce, e-commerce, including the really fast, quick commerce players, and also driving social-first demand generation. Basically, using social media much more effectively to create buzz and sales.
meeting consumers online. Standard playbook now, but essential. And the fourth priority,
This one's maybe the boldest, reshaping the portfolio itself. They plan to invest disproportionately, put much more money and focus behind scaling what they see as high-growth demand spaces.
high growth spaces. Did they give an example?
They did, a really clear one. Body cleansing liquids, body wash.
Yeah.
They pointed out that penetration in India is tiny, under 2%. Compare that to soap bars, which are everywhere.
Under 2%. Wow.
Yeah. So the opportunity, as they see it, is to basically create that market, convert people from bars to liquids. That takes huge, sustained investment in marketing, education, everything. But if they pull it off, the payoff is massive. Classic market leader strategy.
Build the category, then dominate it.
Okay. And all this strategic change is happening while the company itself is changing shape, right? The ice cream demerger, that's moving ahead.
Yes, it is. Shareholders approved splitting off the ice cream business into a separate company. Quality Walls India Limited, or KWIL, back in August. They expect that whole process to be completed by December 2025.
And the new company, KYIL, will be listed separately.
That's the plan. Listing expected probably in the last quarter of the financial year, Q4 FY26, assuming all the approvals come through.
And what does spinning off ice cream actually do for the main HUL business financially? Is it just tidying up?
No, it's more than that. It's financially beneficial. See, the ice cream business runs on lower profit margins than the rest of HUL, partly because it's seasonal, partly because of the costs of cold storage and distribution.
Right, the cold chain.
So by taking that lower margin business out, HUL's overall reported profit margin should actually improve. They estimate by about 50 to 60 basis points. Okay, zero point 0.5 to zero point 0.6 percentage points. Might not sound like a huge number, but for a company HUL's size, that's structurally significant, isn't it?
It absolutely is. It's a material improvement baked into the structure going forward. It shows they're being disciplined, cleaning up the portfolio to focus on the higher margin core business, ready for growth when the market picks up.
Okay, so let's try and wrap this deep dive up. HUL's Q2 showed flat volume, pretty modest sales growth. The reported profit jump was really just that one-off tax settlement masking a slight dip in underlying operating profit.
Right. And the key takeaway on the flat volume is that it wasn't really about weak demand. It was this massive short-term disruption from the GST changes, freezing up the trade channels and delaying consumer purchases.
But beneath that temporary fog, there's a lot going on strategically. A new four-part plan focusing on consumer segments, modernizing brands, digital acceleration, and betting big on new high-growth categories.
Exactly. And they're pairing that with this big corporate move, spinning off ice cream, which should give their margins a nice structural lift of 50, 60 basis points.
So it feels like they're navigating this temporary storm while setting the ship up for smoother, faster sailing ahead, leveraging those long-term positives like affordability and premiumization.
That seems to be the narrative, yes.
So as we finish, what's the key thing you think our listeners should watch over, say, the next year and a half to see if this strategy is really working for HUL?
For me, it comes down to whether they can actually scale the bets they're making on those new low penetration categories. The question to ask yourself is, are things like body wash liquids currently tiny at under 2% penetration? Or those ingestible beauty supplements like the Oziva launch, are they going to become major growth engines?
Or will people just go back to buying the same old soap bars and face creams once this GST noise dies down?
Precisely. Will HUL succeed in genuinely building and leading these new markets? Or will growth just revert to the established core? Keep an eye on their progress in accelerating those high-growth demand spaces. That's where the real long-term story is, beyond just recovering from the GST transition.
Great point. The success of those strategic bets will likely tell us more than any single quarter's results. Thanks for joining us for the deep dive.
My pleasure. Thank you.